This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In this video, I'll be going over the data sets and I'll be doing a quick technical analysis over the SPY for January 9th, 2026. And with that said, let's go ahead and jump straight into the data. Now for January 8th, we had quite a bit of mixture of data. Now, we see the exports slightly rising, but just barely. That's not really enough to do anything. But we're continuing to see the imports drop, and that's not a good thing. The continuing jobless claims did pick up like we anticipated. There was a major, pull down in those numbers last reading, which was kind of odd, but we really did anticipate that it'd pick back up. The initial jobless claims, we did see an increase, but we did not see an increase to the forecasted amount. So the market is still taking that as somewhat hawkish, even though in the grand scheme of things, it's still a very dovish print. You don't want to be seeing the initial jobless claims moving up if you're wanting unemployment to be moving downward. Non-farm productivity, that went upward. Trade balance went down. It's been in the negative, so not exactly a great thing. Unit labor costs, I don't really care too much about that right now. The 1-year New York inflation consumer expectation is 3.4%, so that went up by 0.2%. I disagree with that, but I think the reason why that went up so much was because of this Atlanta Fed GDP now reading. I'm not really sure where they're getting that reading from. I'm assuming because the imports are dropping, which I really think they need to revise the GDP if that's the case, because those don't go hand in hand in terms of showing growth for the economy. Um, you want your imports to not be dropping in this way. Um, and you definitely want to see your exports being a lot higher than that is too. I'm very skeptical about these numbers, but we're continuing to see the imports drop, which is really telling the story. Um, I heavily disagree with this GDP number. I think that's absurd. I know President Trump was ranting and raving about it, but I heavily disagree with that. We'll see though. The consumer credit came in at 4.2 billion. The forecast was expecting 10 billion. So it's still not a good thing, but this is technically a lot better than 10 billion. So, we could take that for what it is. Now, one interesting thing is that last time we saw the Fed's balance sheet grow, and we're actually in a federal or in the process of growing the balance sheet back out. However, this time it actually dropped quite a bit here. Now, this will happen. You will see increases and decreases throughout the week as they're moving funds in and out and everything else, but it is still kind of interesting that we see such a massive drop because that is a pretty massive drop. That means that a lot of short-term bills were sold fairly recently. Now, the reason why I say the data was fairly mixed because you see extremely hawkish data with the Atlanta Fed GDP and the New York 1-year consumer inflation expectations still holding strong is still very hawkish for the overall market. That's going to pull the yields upward. However, some of this other data is definitely helping pull the yields downward, like seeing the um, increase in the continuing jobless claims, seeing the increase in the initial jobless claims, and the fact that these numbers are still so elevated in the first place. Now, going into Friday, January 9th, at 8:30, we have a lot of data coming out. So remember, 8:30 and 10 a.m. are the two really big data or time slots for all the data sets. So for Friday, we're expecting, or we have the average hourly earnings, the month over month and year over year. Building permits, I don't worry about too much. Where the housing starts, that's important because we have been seeing that pull downward in the grand scheme of things. The non-farm payrolls, so the NFPs are tomorrow. Based on kind of what we've been seeing with the ADP, I do expect this to be in line with the forecast. Not so much at the 66. I do expect it to be around the 62. But we'll see about that. That number can gain or drop very quickly based on the current economic conditions. The participation rate, don't really have anything to say about that right now. However, the unemployment rate, they're expecting the forecast at a 5 point, or excuse me, I'm being super dyslexic right now. They're expecting the forecasted amount to be 4.5% from previously at 4.6%. Now, I'm going to swap over to a chart in a moment here, or to a couple charts, but I think that even though I'm in the camp that I do believe the labor market is definitely weakening, that consumer spending has been dropping, and that they will be cutting the rates very drastically pretty soon here. Um, Based on the individual state unemployment rates, which I was going to talk about in last night's video, but they actually didn't come out as of yesterday. They were supposed to. They were postponed for some reason, but they finally did come out, so now we can talk about it. But seeing some of those unemployment rates, I think that that 4.5% is extremely in line with what we should be anticipating. The 4.6% is still very much so in the ballpark of being able to occur though, and here is why. Now, it's not going to show on the actual updated graph. However, the number actually did come in today. So we did get the updated unemployment rate for California. And sorry if you can hear my wife vacuuming. I apologize. Um, it came in at a 5.5%. Last time it was a 5.6. So that is a slight decrease by 0.1%. In the Again, in the grand scheme of things, that's not a huge deal when we have been seeing California's unemployment rate starting to pick back up again. Now, that will show a slight decrease, and that will obviously apply to the overall unemployment rate as well. Now, for Florida, we're actually seeing a large increase. So the previous reading was a 3.9%. Now we're at a 4.2%. So that's a 0.3% increase to Florida. Now for Texas, now the Texas unemployment rate this time came in at a 4.2, so it did have a very slight increase as well. The last reading was a 4.1, so Texas is seeing that 0.1% increase. So why I'm saying that potentially we could still see that the 5.6 percentage unemployment rate is because even though California is going to have that very slight pull down on the unemployment, we're seeing the unemployment rise in Florida, in Texas, and I'm sure very likely some of the other larger states could echo that sentiment as well. Now, for the CME FedWatch, and I actually wanted to talk about this last night, but the section I recorded, for some reason the screen wasn't showing, so I just did not record the whole thing. So anyway, quickly going over this. This is the rate cut chances for, or I should say the monetary policy decision odds from the CME group. This is the one for this January 28th. Now, this was dropping pretty drastically. It went all the way down to 11% at one point. And from, a few weeks ago, that was all the way close to almost 25%. Now, as of currently, it's almost at 14%, so a slight increase, even though today's data, and especially with that GDP and everything, we're still seeing an increase in the odds of the rate cut happening. Now, the big one I really wanted to show yesterday is that going a year out, and this is really important, is that going a year out, the expectations have still been rising for a deeper rate cut um, compared to some of the previous percentages. Now, of course, the data is going to shift on me because yesterday it was a lot lower in terms of the odds of the rates were a lot higher for the 2.5 to 3 percentage uh, interest rate being a year out. Now, that's important because the Fed kind of bases their expectations around a year out. So when we're seeing the expectations, they are dropping, they are starting to lower. Um, However, this reading today is not a good reading compared to the one I was going to show you yesterday, but I can't be selective in my data, so it doesn't really matter. Today's reading has a lot closer to this 3.25%, um, which is quite a bit of an increase compared to yesterday's data. However, with all of the data we're getting tomorrow, or today, depending on when you're reading this or listening to this, I mean, um, these rates should adjust downward pretty drastically again. Now at 10 a.m., we have the Michigan inflation data. This has the 1-year inflation expectation, and this is kind of what I was talking about. The last reading had us at the 4.2%. Very likely we're going to see that pull downward. However, based on, seeing how it did pull up quite heavily today, it might stay around the same reading. 5-year inflation expectation, I don't really care about too much. The consumer expectations and consumer sentiment are starting to pull down towards the 50 range, and once it gets below the 50 mark, that's showing, contraction within consumers, and that's something that's kind of really held everything together because the labor market has been, I don't want to say falling apart, but it's been really heavily deteriorating, and we've been seeing consumer strength not exactly falling off, but not holding on super strong either. So if we continue to see consumer strength weaken, then it will also play hand in hand with what's going on in the actual labor market. Now, the Atlanta Fed GDP is at 10:30. Again, it came in at 5.4%. I don't really anticipate that to change tomorrow. So yeah, tomorrow 8:30 and 10 a.m. are the very key time frames. After that, we don't really have any data other than, of course, that Atlanta Fed GDP now. But going into next week, very quickly, let's see what we got. I believe we have CPI. Yeah, we have the CPI next week, so that means the PPI as well. Um, yeah, interesting stuff. And we also have the unemployment rate tomorrow. Um, which I don't know why I didn't talk about. But yeah, we have the unemployment rate at 8:30. Again, kind of talked about why there was the anticipation of the 4.5%. However, I do think based on all those other large states seeing increases, um, we could potentially see this 4.6%. Potentially even 4.7, but I really don't think we will see the 4.7. I think that'd be a little unexpected. Uh, but yeah, other than that, that's the data.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal Gex and Dex market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And quickly getting into the technical analysis, as always, let's ensure our daily time frame is turned on and our moving averages and Bollinger Bands are turned on. Now, today was a very deceptive day now, and I want to say deceptive because even though it can turn bearish very, very quickly here, the 5 mile will still be moving up tomorrow, which means that by all technicals, if we hold this level and see any form of buying back up towards that 693.96, basically the 694, then that's going to tell us that there's actual strength to these moving averages, that they're not going to suddenly start curving back downward. We're also seeing the upper Bollinger expanding to the upside. We're seeing the lower Bollinger pulling upward, which that's something you want to see when the market is starting to hopefully rally again. I apologize for that. My daughter was barging into the room, which was making the microphone cut out. Um, anyway, it looked like a selling day, but I'm going to show a few reasons why I don't believe that was the case. The 5 mile again will be pulling up on open tomorrow, not by a whole lot. I anticipate the 5 mile to be around that 689 range, almost on the dot. It might be at the 688.80. It might be even less. You just have to be very aware of where that level is at the open, because when we're opening at the 5 mile, that becomes a very, very key range because we have to be aware of both the upper bounds of the 5 mile and the lower bounds of the 5 mile, which again is the $1 to $2 above the actual moving average range. So, assuming the 5 mile is going to be at the 689 tomorrow, that means the upper bounds will be at the 691 and the lower bounds will be at the 686. So we still have quite a range. We could still see the market pull down to that 686 range and then pull back up. Based on the hourly chart, and just go ahead and turn off the Bollingers and the moving averages. And jumping into the hourly time frame, let's go ahead and show the drawings. Now, again, we've been talking about this continuation of bull structure, how we have the cup, we have a nested cup that's formed, completed, and now we're looking for the handle. Now, oddly enough, this is starting to look a lot like a handle. And with this is that this is right at the 5 mile, and I'm going to put this marker here just for a moment to kind of label that 5 mile range. Let's go ahead and make it a clean. All right, so here's really what the deal is for tomorrow is that either we are going to, where is the lower bounds? I want to show this visually. At the 686, but it's actually the 687. That's the lower bounds. My apologies. So we're going to go ahead and put blue on this to signify the lower bounds, and yellow stay there, basically the upper bounds. Now, if we push downward in the 5 mile and we head down to the lower bounds, which is that blue range, then potentially we have this head and shoulders right here that can continue formation, and this will cause an inverse cup to form. Mark this in light purple just to make it somewhat visible, and that will allow further continuation downward, um, if we're going to continue downward. Now, if we start breaking below this 687 range, that invalidates this upside. That'll invalidate this upside cup. we then have to again wait for further bullish structure to then build towards that upside. If we're going to actually have the upside with all this, you know, potential bullish structure that I've been seeing. Now, again, if we pull upward towards that 691 and start breaking above that 691 range, then that means that we're going to push away from the 5 mile towards the upside. And let me mark the upper Bollinger. And the upper Bollinger is truly not too far away from that. It'll technically complete this cup, have a push above the cup, which again, for all cup structures, if this isn't going to be the massive breakout that I'm expecting, then we will be, anticipating bearish structure to form in here, small bearish structure forming in there, probably some sort of head and shoulders type structure, pull downward, create some form of bullish structure at the bottom, and then head back up. Okay, so that's kind of the anticipation from here. And if we pull above this upper Bollinger, which is the red line, if we close above that line, that's going to show that we're going to be getting at least 2 days of bullishness. Because again, day one of upper Bollinger move, you close at or above the level. Day two, you generally see a higher high, and then you start seeing consolidation downward. Now, as we start to consolidate downward, the 5 mile will slowly start pulling upward with us. And that's how you get the bottom of the handle again, retest the 5 mile again, and head upward. So that's what we're looking for if this is going to continue seeing bullish upside. And we continue to wait for this to happen until it happens, basically. And the other outcome is that, again, we start breaking downward. Let's pull this to the lower bounds. Set that to the 5 mile level. We start breaking downward, and then we start targeting the 10 mile, having the 5 mile cross the 10 mile, targeting the 20 mile, having the 5 mile crossing the 20 mile. And that's when I talk about where this area could be very confusing. It can look very deceitful because it can look very bearish. Especially right in here. This looks like a very bearish head and shoulders. However, the shoulders are very, very misaligned and they're actually pulling to the upside. On this second shoulder, you don't have any form of lower low or anything else like that yet. So to me, this looks like a very bullish rejection for liquidity to see further upside. Now, to turn off the drawings, going back to the daily, and what I wanted to show, another reason why I believe that we are going to see actual buying is that the VVIX on, yesterday or the 8th's quote unquote selling was not moving upward. It was actually pulling downward majority of the session. That's the hourly, 30-minute time frame. Basically created a head and shoulders, very likely suggesting it's going to pull downward, which very, very likely suggests we're going to see buying within the SPY. Not many people are hedging their equity right now. That's exactly what the VVIX dropping is telling you. Even though we saw a little bit of action within the actual VIX today, this is only telling you that there were some puts taken against the SPACs, um, or the S&P, but that's a lot different than what the VVIX reads. The VVIX, I'm going to lose it reading that name. The VVIX tracks the actual insurance premium, so this is telling you when the actual insurance is being purchased up or not. As of today, that insurance wasn't being purchased up. If we're going to be seeing actual downside, you would assume insurance would be purchased up prior to it. So, uh, really, I'm not anticipating a whole ton of further downside from here. If we are going to see downside, then again, we will be having multiple chances to catch it because you do have to go through the entire 5 mile, go through the lower bounds of the 5 mile, go through the 10 mile, go through the 20 mile, and if all those start to break through, then that's when you can look at the lower Bollinger. So yeah, that's the technical analysis for tonight. Um, Really, I'm expecting upside. I'm going to be very surprised if we see downside, especially with the ADL, and I know it's kind of hard to see here, but even with today's session, the ADL was pulling upward, meaning money was flowing into the fund, not out of the fund. So, I do believe that today's selling was very deceptive. I don't really think it was selling at all. Um, I just think it's just bullish liquidity uh, to pulse back up to all-time highs again. So we'll see. If we're going to go to all-time highs, then we will be seeing that 694 very, very likely tomorrow. So with that said, um, I will talk to you all in Sunday's video. Thank you all for watching. I appreciate you all putting up with me when I'm sick and not sounding good and just everything. I heavily appreciate it. Thank you all. Let's have a really good week or, end of the week, and I will talk to you all in next video. Take care.